Here's what nobody tells you about dividend investing. Watching the market every day actually makes you less money. Josh discovered this the hard way. The more he obsessed over price movements, the more out of control he felt. So he asked himself one powerful question. What if I just let my money work while I sleep? The challenge. Could a simple $100,000 dividend portfolio generate real, dependable income? Not theoretical gains, not paper profits, but actual cash hitting his account every single month. Enough to cover bills, groceries, maybe even replace his entire paycheck one day. What you'll learn. In this video, I'm breaking down the entire strategy from scratch. How to pick dividend stocks that actually pay consistently. The exact portfolio structure Josh used. Real month-by-month income breakdown. And how this portfolio could grow to $2.76 million, paying over $10,000 monthly. Let's dive in. Before Josh bought a single stock, he had to change how he thought about money. He stopped asking, how do I beat the market? And started asking, what job do I want my money to do? He didn't want excitement. He didn't want to constantly make decisions. He wanted steady, predictable growth that worked even when he wasn't paying attention. That's where dividends came in. What are dividends?
Simply put, when a company makes profit, they can share some of that profit with shareholders. You own the stock. They pay you cash. Real money you can spend or reinvest. And here's the magic part. The power of DRIP. DRIP stands for Dividend Reinvestment Plan. Instead of taking dividends as cash, they automatically buy more shares. Those new shares earn dividends. Those dividends buy even more shares. And suddenly, your income starts feeding itself. This is compound interest in action, and it takes all the pressure off because dividends arrive on schedule. Reinvestment happens automatically. Time does the heavy lifting. With this foundation, Josh knew exactly what kind of companies to look for. The stock selection criteria. Josh didn't pick stocks randomly. He used 5 specific filters. 1. Stability first. Only companies with long track records of steady profits and consistent dividends. If they've paid through recessions and market crashes, they're starting from strength. 2.
Dividend history. Not just companies that pay dividends, but companies that maintain and raise them year after year. Growing dividends mean growing income without adding new money. 3. Healthy payout ratios. He targeted companies paying out less than 60% of their profits as dividends. Why? If they're paying out everything, one bad quarter could kill the dividend. Room to breathe equals sustainability. 4. Sector diversification. Never put all your eggs in one basket. Spread across consumer goods, utilities, healthcare, industrials, real estate. When one sector struggles, others balance it out. 5. Mixed payment schedules. Some companies pay monthly, others quarterly. Mixing them smooths out your income throughout the year. No 3-month droughts. Now here's how Josh structured the actual portfolio.
The 100K portfolio structure. Josh split his $100,000 evenly into 4 categories, putting 10% into each position. This keeps everything balanced. No single stock can wreck the results. Category 1, Dividend ETFs, 25%. Instant diversification across dozens of quality companies. Lower risk, steady income, and a foundation that won't crack under pressure. Category 2, Blue Chip Dividend Stocks, 50%. Established giants with decades of dividend payments. Boring? Maybe. Reliable? Absolutely. Category 3, REITs.
These stocks raise their payouts over time. But before we reveal the exact holdings, let's talk about the mistakes that quietly destroy dividend portfolios. Mistakes that kill dividend income. Mistake number 1, chasing high yields. A 10% yield looks amazing until you realize the company is struggling and about to cut the dividend. High yields often signal danger, not opportunity. Mistake number 2, expecting monthly payments. Most companies pay quarterly. That's normal. Don't avoid great stocks just because they don't pay every 30 days. Mistake number 3, poor diversification. Loading up on one sector, tech, utilities, whatever, means when that sector drops, your entire income drops with it. Mistake number 4, taking cash too soon. When you're building wealth, reinvest everything. Those small dividend payments turn into more shares, more income, and exponential growth over time. Now, let's see the exact stocks inside this portfolio, the complete portfolio breakdown. Dividend ETF Foundation, SCHD, Schwab U.S. Dividend Equity ETF, 3.75% yield, acts as the portfolio anchor, filters for financial strength, sustainable payouts, and consistent cash flow across multiple sectors.
All right, now for the moment of truth, month-by-month income breakdown. Let me show you exactly what hits Josh's account throughout the year. January, April, July, October. Realty income, $47. Procter & Gamble, $76. Air Products, $78. AbbVie, $78. Monthly total, about $279. February, May, August, November. Realty income, $47. Nexstar Media, $94. Consolidated Edison, $89. Johnson & Johnson, $65. Monthly total, about $295. March, June, September, December. Realty income, $47. SCHD, $94. Coca-Cola, $73. PepsiCo, $98. Monthly total, about $312. Year 1 total, $3,544 annually. Average, $295 per month. Now I know what you're thinking. $295 a month from $100,000, that's it? Here's why that reaction misses the entire point, the long-term compounding effect. This portfolio isn't built for instant gratification. It's built to snowball. Year 10, annual dividends, about $10,000. Monthly income, about $830. Portfolio value, about $288,000. At this point, dividends can cover utilities, insurance, part of rent, real bills without touching your paycheck.
Year 20, annual dividends? Seriously, almost $35,000? Monthly income? $3,000? Portfolio value? Over $870,000? Now we're talking major living expenses covered. Housing, healthcare, transportation, all from passive income. Year 30, annual dividends? Over $124,000. Monthly income? $10,000 plus? Portfolio value? Over $2.76 million. Full financial independence. Josh could walk away from his job completely if he wanted to. The bottom line, most people think investing is about picking winners and timing the market. Josh learned it's actually about picking quality companies, letting dividends reinvest automatically, giving time permission to work. $295 a month becomes $10,000 a month, not through luck, but through patience and compound interest. If you want to see another dividend strategy that could turn just $10 into a $2.2 million portfolio, paying $6,000 monthly, check out the video on your screen right now. Thanks for watching, and I'll see you in the next one.